At this time, we'd like to present some findings from our Guaranteed Lifetime Income Survey. Doug Kincaid, our Assistant Vice President and Project Director, will start it off, and I will also present some information and observations, and then we'll turn it over to you for any questions or comments you may wish to make. We ask that you bring forward any comments during the presentation in chat, and when we're finished, and we will leave time, we will welcome any comments in chat or orally. So with that, Doug, if you can start. And also, if anyone's interested in this deck, we'd be glad to send it to you after the meeting. Just let us know if you want to see the hard copy of what we're presenting here. Doug?
Yeah, thanks, Matt. And thanks, everyone, for joining. We're excited. We released this, this study this week publicly. So this is part of the rollout of what we found. And I think some pretty compelling stuff this year, and are excited to be able to share some of it with you. Quincy, if you don't mind moving forward. Just wanted to start off with some basic descriptors of what the study was, because it's kind of a unique one. First of all, we've been partnering with CanX to do the study. We thought about it 6 years ago, talking to CanX, and have kept it going on the consumer side for 6 years. So it's a trend study that allows us to look at differences in attitudes, behaviors, interests regarding guaranteed lifetime income, income planning, and annuities specifically. And last year in 2019, we started for the first time doing a kind of companion advisor study that was built to have a lot of points of comparison between advisors and consumers, because this is an especially important area to really understand where the disconnects are between advisors and consumers when it comes to lifetime income and annuities. So in terms of kind of the specific studies, the main thing to keep in mind for the consumer study is that we were looking at people 55 to 75 with assets of at least 100,000. So this is not necessarily general population. It's more of the target market for what these products are typically aimed at. And the advisor study, you can see some of the details there that I won't really get into, but the main idea was that we were trying to have it represent the advisor population that these consumers would likely be working with. Of course, the most important point here, which is typically a throw-in on these methodology slides, is when this study fielded, because this is not the typical year. And the consumer and advisor fielded at the exact same time, and they fielded in kind of mid-February, which is when we've been fielding it for the last few years at least. But this year was different, and you can see the timeline on the bottom here of it kind of mapped against what the market did and what the interest rates were looking like. It was, during a very, I shouldn't say very rosy period, but in comparison, a pretty stable market. Interest rates were low, but they were kind of where they were at that point. And why that's important is because pretty much immediately after, we saw the market effects of the pandemic start to unravel. And so pretty much the day after, this is basically conducted on the eve before all of the market downturn that we experienced in late February and into March, obviously occurred. So that context is critical for understanding what we're talking about here and thinking about what this means for the current environment too. So I'm going to start off talking about a lot of these issues, related to market volatility, but also just interest in annuities that we've captured from consumer perspective and thinking about what advisors have to say about it. And then in Matt's section later is going to address, what advisors' role is and how advisors differ from consumers on some of these topics. So getting into the first finding here, would have loved to have the foresight to know that the downturn was coming myself, but we at least had the foresight to ask the question of advisors and consumers. What did they think the likelihood of experiencing a major downturn would be? this year, 2020, but then we also asked the next 5 years for advisors and consumers, and for consumers at some point during your retirement. And this was definitely one of the big headlines this year because it was timed to be right before the downturn, and yet only 6% of advisors, even less than consumers, 6% advisors thought it was highly likely that one would occur in 2020 right before it did occur. And the consumers not much better, 11% highly likely. So really highlighting the fact that this was a black swan market event that advisors and consumers alike didn't see coming, which is an important context for thinking about how people consider products that are in part built to protect you from things like this. One of the other important points before we move on real quick, Quincy, to point out is that even when you're looking at consumers in the next 5 years and at some point in your retirement, it's not that high that people thought, in the next 5 years, only a third thought it was highly likely to occur. So it's not just this year that people were hedging their bets, but it was a very rosy outlook for a lot of people in general. Of course, what does this mean in terms of how people perceive guaranteed lifetime income? We've asked this question of consumers since the very beginning, and you can see it could have an effect. We saw a lot of volatility in 2018, and we thought that contributed to a large extent in why the perception of value of guaranteed lifetime income in addition to Social Security jumped up the way it did. As markets were kind of increasing from 2014 to 2016, we were seeing this decreasing value. All of a sudden it jumped up. And then since 2018, it's kind of bounced around a little bit, but it's been a fairly stable result that consumers see a lot of value in the concept of guaranteed lifetime income, which is to say that, it's hard to turn down guaranteed income, but this is an important kind of consideration. Do people at kind of the conceptual level appreciate the value of what guarantees could deliver? And 71% you can see say it's highly valuable, and that includes 51% who say 7 out of 7 extremely valuable. So even in the context of this year, a lot of people seeing the value in having guaranteed lifetime income. We asked advisors in particular, and again, this is before the downturn, but we wanted to understand from what we were starting to see over the trend of the consumer study and kind of reading into that being maybe affected by market conditions and interest rate. We asked advisors what they thought these two things impacted on how consumers and how their clients' interest level varies in terms of GLI annuities. And you can see the top two charts here were based on that current condition in early February. 65% of advisors saying those conditions, probably some volatility, but overall okay. Increased appeal for annuities, and the low interest rates of the early part of this year, 42% said that increases the appeal for their clients. One thing to note about these charts is that the opposite is not decreased. Most of the other people who didn't say it increased were saying that it doesn't impact. So very few people saw these as negatives for interest. But the bottom charts, I think, are the most interesting here. Advisors saying during previous market downturns, 61% of those advisors said that their clients on average had higher interest, and the same with low interest rates, not as high, 37%. But again, the opposite was basically no impact. So a net positive on both of these fronts in terms of what advisors said the interest from their clients was. Of course, interest in the concept of guaranteed lifetime income doesn't necessarily translate to, what their interest is in an annuity. And this is something that we've asked about in the last couple of years. We start with that conceptual question: do you appreciate the value of guaranteed lifetime income, period? And then asked consumers, what your interest level is in a financial product that would guarantee you a certain amount of guaranteed lifetime income. And then we have always followed that up then specifying what if it was an annuity that guarantees you with a certain amount of regular income. So basically the same exact question, the only thing that we changed was calling it an annuity versus a financial product. And this is something that we've seen here before, but the stigma of the word annuity seems to emerge just from changing it from a financial product to an annuity. You can see 33% gave it a lower rating in terms of their interest in owning an annuity that delivered guaranteed lifetime income. I think we've thought about this a lot, and we've asked follow-up questions in previous years about why that interest changes. We can talk more about it kind of at the tail end of this coffee break. But one of the things that has always stuck out is that I think unfamiliarity with annuities and kind of complex financial products really gets magnified when you present that specific product to people. All of a sudden, the idea that there might be more dynamics behind the scenes starts to make people a little wary about committing to saying that they have interest in it. So kind of understanding confusion points, I think, is a really critical aspect to understanding where the stigma of the A word, annuity, comes from. And so this year we asked that specifically, both of consumers and that have said that they find annuities difficult to understand. And then we also asked advisors, what aspects do they see as difficult for their clients to understand when they're discussing it? And you see a very remarkable result in this chart that, normally when we pit advisors against consumers, we're doing it because we know that there's going to be some differences of opinion, and understanding where those gaps are is a really interesting exercise to kind of pinpoint where the differences lie. Here you see a very similar response from both parties, from both advisors and consumers, basically identifying what they see as the top kind of confusion points: fees and costs, different types of annuities available, and the tax implications of owning. So I think those are really important to think about in terms of where do we see the biggest pain points for both advisors looking at trying to explain this to their clients, and also for consumers kind of reflecting on the products themselves. I think the tax implications and the fees and costs are things that we know are pain points and are issues to work out. I was pretty interested in the second one here, though, the different types available, that we typically see as kind of a positive of there's more types available. You can find the one that fits whatever needs you have. Here you can see both advisors and consumers saying that actually causes a great deal of confusion for people just trying to kind of wade through all of the differences that are available. And you can see the stat at the bottom, which is a pretty compelling one too. 50% of non-owners, so people who don't own a guaranteed lifetime income annuity, said that they would actually be more interested in purchasing it if it was easier to understand the options. So that segue, I think, works well in terms of then talking about the advisor role in this, because trying to grapple with what's confusing is in large part something advisors are confronted with. Matt?
Thank you very much. And I will move now to more focus on the advice and what leads to the adoption of guaranteed lifetime income or not. So if I can get right to the next chart, with regression analysis, find two factors which contribute to a consumer getting guaranteed lifetime income. One is having an advisor, not surprising. Don't have a relationship with an advisor doesn't mean you never meet with an advisor, but a relationship with one who leads to purchase of annuities with guaranteed lifetime income, because people don't get this on their own. And secondly, and I think more importantly, having a discussion about income strategies contributes to using guaranteed lifetime income is one way to implement that strategy. Going to the next chart. It is interesting and I think important the extent to which advisors underestimate the receptivity of their clients in guaranteed lifetime income. Only 14% of advisors believe that their clients are highly interested in guaranteed lifetime income. But we find that 42% of the consumers we interviewed are either highly interested or else already have guaranteed lifetime income, which is the strongest possible demonstration of interest that one can make. So the basic point is that many advisors assume their clients are not receptive because I think they're not receptive to selling it, but they are in many cases making a mistake in underestimation. And this is a training issue and issue to point out that people do value guaranteed lifetime income at the point of retirement. If we go on to the next chart, we see that consumers don't think that advisors in general do a very good job of explaining these often complex products. This is presenting people who bought or did not buy, but they discussed annuities with an advisor. I don't want to take the time now to go through all the details of where the explanation drew short. You could see the lighter blue line is fairly low with the people who wound up not buying. But I think the main point is there are a number of advisors, even if they discuss guaranteed lifetime income, need training on the most effective way to present this product, at least as an option or a solution, as an option of a way of meeting the income challenge in retirement. There's a training issue here. Next chart, please. Now, I think there are two beliefs that are important that often are not acted upon, but still there's basic acceptance of these ideas. The first one is the idea is that, quote, advisors should, quote, present their clients with 2 or 3 options for how to get income for their investments so their client can accept the option that's best for them. I don't think this often is implemented, that 2 or 3 options are presented, but 75% of advisors agree with that statement, that they should present 2 or 3 options of how to get income. And perhaps more importantly, 4 and 5, 79% of consumers believe that, and the advised consumers, ones with professional advisors, are more likely to believe this. So this is something perhaps if you want to market guaranteed lifetime income, to remind advisors that this is something that their clients often want. If we go on to the next chart, we see that that 7 in 10 advisors also believe they have a responsibility to present financial products that provide guaranteed lifetime income retirement as an option to their clients. I once had an uncomfortable focus groups with RIAs, and I asked them as fiduciaries, do they have the obligation to present guaranteed lifetime income? They weren't doing it at the time, but they struggled with, should a fiduciary do that? But by and large, there's a belief that there is some responsibility to present this as least as an option. Going on to the next chart, please. And finally, when we ask people what helps in retirement planning of the different things we mentioned, the idea of telling people what monthly income in retirement they can get based on their assets. This is the translation of how much prudent income one can take out of their assets. And this was of the things we generated, what was considered most helpful. Over half, little over half, think this is the most helpful thing that an advisor could bring forward. A lot of people not really aware. There's a lot of discussion of the 4% rule, but still, considering a variety of circumstances, personal each person, how much they can prudently take out is a valuable, is considered a valuable discussion and something people want. And finally, if we go, just want to make some observations about this. If we go to the next chart, these are our interpretations. The low interest rate environment that suddenly decline of the market encourages the use of guaranteed lifetime income. Now, the market declined and came back, and we'll see over the long term how much of an impact that has. But for a long time, bond laddering and the use of fixed instruments was the key, the foundation, in addition to Social Security, of getting income in retirement. And now we're in a place where that doesn't work very well because it kills the return of an overall portfolio. So I have people in retirement who have an increased concern about investment risk and have this option of fixed rates as a way of dealing with that less effective. And where do they go? There are options other than guaranteed lifetime income that can deal with that, including options. But this is one. So I think that we're in a new climate right now with extremely low interest rates, and that presents a significant problem for advisors, and GLI is one way to do it. Among the impediments to more use of this is advisor underestimation of consumer interest, training issue, shortfall in income strategy discussions, a training issue, and the negative image of annuities, a persistent problem that's not easily solved. And we think there are two discussions that are key. Effective discussions about retirement income need, which I think go more than how much income you need, but the components of that, how much of that is flexible and how much of its essential expenses are inflexible, how much flexibility do people have, because they have flexibility even with essential expenses. Don't get steak, get Franks and beans. And the effective presentation of retirement income options, which I think advisors need some help with. And just to mention one thing, one solution I think we're going to go for is model portfolios that do the work, that can incorporate guaranteed lifetime income, something else, that have an overall portfolio solution that will help advisors who struggle with doing this because they haven't had to do it before. But the main thing is, I think a consumer preference is clear. They want 2 or 3 options for ways to obtain regular income in retirement, with one obtaining guaranteed lifetime income. And with that, we have cleverly left some room and some time for questions and comments, and welcome all, either through chat or any other way. Anything you'd like us to expand upon?
I see there's one question in chat, just to clarify the asset requirement for advisors. That was the assets under management that they're personally managing being 15 million or over, not the advisor's assets.
Anything else? Well, I'm glad we saved enough time for questions, because I have one I'd like to ask. I presented information about the annuity stigma, and I'm wondering if you've seen any evidence of change in that over time?
Yeah, so I think I mentioned it to some degree, that we've asked the question before and that we've seen that result before. It's actually been somewhat surprising to me that it's been so stubbornly locked at that basically the same number, a third decreasing their perceived or their interest in annuities versus just a kind of generic product. And it's a little surprising given that in years where we saw stronger agreement with the positive statements about what annuities deliver, there wasn't kind of a corresponding decrease in the stigma that we were capturing there. And even this year, we had fewer people saying that they heard or read positive things about annuities in the last calendar year. And that didn't seem to kind of impact the other direction, this annuity stigma that we've seen. So I think we've been thinking about kind of what this means. I think it's in part kind of pointing to how entrenched this type of response is, whether it's kind of long-standing views about annuities that aren't easily moved year to year, or they're not engaging year to year and they're just kind of thinking about what they've always known about annuities. We've also seen, I mentioned that the positives and negatives have kind of changed year to year, but really it's positives that on certain years we've seen gone up or come down a little bit. The negatives, things that people have a problem with annuities, that stays pretty much stable every single year. So I think also trying to solve for the negatives is a much trickier issue going forward. And the fact that education and being harder than just marketing. So yeah, there's been really no change in that stigma question, at least since 2018.
We have a couple of other questions. And by the way, Quincy, I think if you can unmute people, if they are muted, I would appreciate that. I ask for comments and let's make it easy. Fred Barber, hi Fred, asked if we were surprised that advisors didn't predict the market downturn. I think no, because it's very difficult. Now, we knew in January there was this pandemic, so you would think that this might have been an easier one. I think it might have an impact. But most advisors don't try, and I think that we can say it's been proven that you can't do, which means you have to be ready, and I think that's the issue. And if you remember, we asked people how likely it would be that sometime during the retirement there would be a downturn. I think that there's been a downturn of at least 50% in value once every 22 years since 1910. It does happen. If you're going to be retired for 30 years, likelihood that there's going to be a major downturn and a quick recovery, which we may or may not have now. So I think that it's not surprising that people can't predict a downturn. And the question is, what do you do if over the course of retirement, there is, let's say, a strong likelihood that there will be a downturn without a quick recovery?
Yeah.
We also have a question, with the Secure Act, is there any data showing any positive impact to consumers and advisors on annuity this year? I think there's some evidence that there's some more interest among plan sponsors in getting information on that, although to some extent the pandemic really overpowered it. But it seems to me that it's a little early for that. And
we did ask advisors. We didn't want to ask consumers about the Secure Act in this survey, but we did throw in some questions just to advisors. Obviously, the Secure Act's impact for annuities much greater, as Matt's saying, for plan advisors. But there was a pretty positive response in terms of advisors saying that they thought clients would be more receptive going forward because of the Secure Act, whether it kind of establishes these annuities more in people's minds or helps gain familiarity for people. That was something that advisors kind of forecast as having a positive effect in terms of receptivity.